Good afternoon, everybody. This is Todd Zumpel with Gordon Asset Management. Here today, we'll share with you the market update. Joe Gordon, who's normally on the call, will not be attending today's webinar, but I'll give you the pleasure of my lovely voice as we go through the data today. So to jump right in, so disclosures, of course, this information is for educational purposes only. It's not to be considered investment advice. I myself am a performing monkey. Don't believe anything I say. Check everything out for yourself. Use precaution when investing. Follow us on YouTube, social media. So every video that we do, every webcast that we do is posted to our YouTube channel. Just search Gordon Asset Management. We also pump out some pretty interesting content through Facebook and Twitter. You can find us at WealthQB, like Wealth Quarterback, at wealthqb.com, or at WealthQB Twitter as well. So looking at coronavirus update, so U.S. coronavirus cases jumped from 4.3 million last week to 4.7 million this week. So that is not positive. However, hospitalizations have actually decreased from 59,000 to 53 week over week. So that is a positive sign. Deaths have continued to climb. We've continued to see record numbers there, which is not positive. But the death rate has also started to decline. So we kind of have a mixed bag of data on the COVID update. No real takeaways. I will say that hospitalizations decreasing is probably the most positive news out of there. So despite the fact that cases are increasing, hospitalizations are going down. So that's very positive. Looking at international markets this week, EFI, which is developed foreign, fell 1.1%. Week over week. It's currently down just under 10% year to date. So it has not been a great place to invest year to date. Emerging markets rose 1.64% last week, primarily led by a rally in China. So emerging markets in general are down about 3.3% year to date. So we've seen some positive developments there. There's a lot of positive developments in terms of e-commerce in emerging markets, which continues to be sort of this interesting investment thesis. When we look at global bonds represented by the Barclays the Barclays Global Bond Index, up slightly, 55 basis points on the week, currently up just under 6% year to date. What's interesting here is if you look at all three lines on the chart, you'll notice having a diversified portfolio representative of both stocks and bonds is your friend when volatility happens. Over in the US, things were pretty good last week. S&P gained about 2.5%. It's currently up about 2% year to date. So that's very positive. The NASDAQ just again had a tremendous rally, up 5.5%. We're up just under 27% in the NASDAQ year to date, which is absolutely crazy to think about if you think about where we've been this year. The Russell 2000, which is small companies, small cap companies, also rallied last week, up about 2.7%. It's currently down about 9.5% year to date. When you take a step back and look at the Russell 2000 and the companies that make up the index, there's a lot of banks, regional financials, as well as energy, which both sectors had underperformed year to date. So that's part of the reason why the Russell 2000 isn't looking so spectacular year to date. Typically, when we look at recessions and rebounds in the economy, small cap stocks tend to lead the economy out of a recession. Hasn't been the case this year. Again, you know, the heavy weighting towards financials in this environment has been sort of anomalous with low interest rates. Banks are obviously having a hard time generating profits when there's not much margin to make on the interest spread. Also energy, with people staying at home, traveling less, burning up less fuel, not to mention with production increases that we've had in oil over the past year or so. It's all been very negative for the energy sector. So Russell 2000 has continued to trail. The Barclays Ag, US Ag, so US bonds, rose a little bit last week, 20 basis points, currently up 7.5%, which is, again, pretty stellar. And as I mentioned on the previous slide, having that nice balance of both equities and fixed income is your best friend when volatility strikes. Moving on to the next slide, we look at sector exposure. So of all the sectors, S&P sectors, technology has been the best, which again is why the NASDAQ has really performed well. Technology sector is up about 23% year to date, followed thereafter by consumer discretionary and consumer staples, both up nearly 10% year to date. Energy and financials, as I mentioned on the previous slide, have been the major detractors. Energy down still about 39%, and financials down about 22%. When we look at opportunities in the value space, things that look potentially kind of appealing from a price to earnings standpoint, there's potentially some options in energy and financials, but again, we have these macroeconomic headwinds of low interest rates and the stay-at-home economy, which are the reason why those sectors aren't performing very well. So it's something we're keeping our eye on. If we see a change in some of those macroeconomic factors, there may be some good opportunities to fish out of those two sectors. But moving on, we look at the disparity between cap-weighted and equal-weighted index, and this is something we look at frequently and talk about frequently on these webcasts. The NASDAQ and the S&P are both market cap-weighted indexes, which means that the indexes are heavily weighted towards the larger companies. So the Amazons, the Microsofts of the world will tend to make up more of the index when it's market cap weighted, because they have larger market cap. Equal weighted basically means that we redo the index, but every company in the index, so every 100 companies in the NASDAQ, every 500 companies in the S&P gets equal shelf space. And when we look at the performance disparity between the cap-weighted indexes and the equal-weighted indexes, you'll see that there's a significant disparity. In the NASDAQ, it's roughly 10% between the cap-weighted and the equal-weighted index. And then over in the S&P, again, up 2.2% year to date in the cap-weighted index, but the equal-weighted index is actually down nearly 7%. So what does that mean? That means that the larger companies are really driving all the returns for the market. And here's a more granular look at that data. So if we look at the largest holdings in the S&P 500, for instance, you'll see that Apple makes up nearly 6% of the index, along with Microsoft, Amazon 5%, Facebook 2%, Google around 3%. When we look at that chart, you can see some of these stocks have performed very well. Amazon up nearly 70%, Apple up 50%, Microsoft up 35%, Facebook up 22%, Alphabet up 10%. All these stocks have performed very well, but you can see the index is up just over 2%. So the larger companies are really buoying the performance in the market this year. It's a little bit concerning because if the story changes, if these companies start to underperform, earnings aren't great, that could really have a negative effect on the broader market. So many of the eggs in the S&P 500 basket are these large megatech companies. The good news is that we've had some earnings come out this week, and earnings are actually pretty good. So despite these companies being enormous, they continue to grow at really strong rates, and continue to earn money and be profitable. So this is interesting to note, but there's been this centralization of control, really, in the stock market as well as the performance. So these funds continue to do, or these stocks continue to do well, and have really pulled the market along with them. When we look at valuation measures, so again, this is something we look at nearly every week. Price to earnings, forward price to earnings ratios around 22 times, which are extremely high by most measures. And that's a function of a couple things. Number one, earnings in a lot of companies are terrible. So when we look at price to earnings, when the earnings go down, the price to earnings ratio goes up. Also, there seems to be a lot of money flowing out of certain areas of the market, fixed income, cash, and into the stock market. So that's driving price up. You know, it's very interesting. There's been a lot of individual stocks that have just rallied on bizarre news lately. Eastman Kodak has been one that's up. I have no idea how much that stock is up over the last 2 weeks, 1,000% or plus. I don't even know what the number is. It's just off the charts because they struck a deal to produce generics, generic pharmaceuticals for the U.S. government, which is very bizarre. You know, you talk about this film and camera company that was just kind of floundering along, struck a deal with the government to produce generic drugs, and now that stock's just off to the races. You know, you see a lot of these cases. A lot of small-time investors, they catch wind of some of this stuff and invest in their fintech, Robinhood type trading accounts, and really drive the prices up and drive them up quickly on news for a lot of these stocks. So this is something we're watching. Again, we're in very unusual times. We expect earnings to get a little bit better as we get a little bit farther out from COVID. So we hope that this price to earnings ratio starts to normalize. But again, it's something we're keeping an eye on. Now, speaking of COVID, to fight the battle against COVID and keep the economy alive, not only the Federal Reserve, but really all central banks throughout the world have really expanded the monetary supply in an effort to ease liquidity and help buoy the markets. And you can see that here in this chart. It goes back to 2003. You can just see the massive expansion of the Fed balance sheet, just purchasing treasuries, mortgage-backed securities, securitized loans on behalf of the government. It's really off the charts, the amount of monetary expansion that the U.S. has had. And you can see that here again in this chart. So if you look at M2, which is a measure of the monetary of the money supply, you can see year to date the money supply is up 20%, which is crazy to think that the U.S. money supply is expanded by 20% just this year alone. That is just very bizarre economic data to see. And what's even more bizarre is you chart this data against the consumer price index, which is a typical measure of inflation. So inflation has been benign so far, 0.32% year to date. So despite expanding the monetary supply by 20%, we haven't seen any inflation. Inflation is a lagging indicator, though. So even though we haven't seen any yet, we fully expect to see some in the future. I mean, you just can't expand the money supply by 20% and not expect any inflation to occur. It could happen, but that would sort of defy the laws of modern economics by most measures. What's interesting, again, to see is we then chart this data against the price of gold. The price of gold is up nearly 30% year to date. And as you can see, it sort of closely has followed the expansion of the money supply. Also, that trend line of the expansion of the money supply, if you look at that versus the S&P 500 index, you can see, again, the curve is very similar, which again goes to the point that the market has been primarily driven by Fed and fiscal stimulus as well as monetary stimulus this year. So this is, again, something we're keeping our eye on. We're a little bit concerned. We hope that inflation won't rear its ugly head, but we're definitely keeping an eye on it. Harkening back to the previous slide, traditional inflation indicators don't reflect the monetary increase. Headline, CPI, Consumer Price Index, core CPI, these are just various measures of inflation. And as you can see, we're below the averages. It's been benign thus far. So we're keeping an eye on it. Like I said, inflation's a lagging economic indicator. So we fully expect to see some in the future, but we just hadn't seen any yet. Looking back in the U.S., continuing claims for U.S. unemployment have sort of leveled off. The unemployment rate has been sort of holding steady at about 11%. The peak were close to 15. Initial claims had risen week over week, just slightly. As well as continuing claims for unemployment continue to be around 17 million, which is up a little bit from last week. So again, this is something we're keeping our eye on. We're a little bit concerned looking forward that a lot of the unemployment thus far has been in the service sector, hotels, restaurants, hospitality, travel. We're keeping an eye on a second wave. I think there could be a second wave in more blue collar or blue to whitish collar jobs, more professional jobs. We already started to hear some of the airlines are going to lay folks off after some of the loan guarantees and stimulus that they have been given goes away. So there very well could be a second wave of unemployment coming down the pike. Just locally in our backyard, folks that I talk to, it seems like many companies have folks staying at home. And I think eventually as some of the PPP funds and whatnot wear off, they could be potentially just asked to stay home permanently and not come back, or maybe even take part-time positions. So that's something I'm a little bit concerned about. I'm sure you folks on the call talk with people and sort of hear things, but I think there could be a second jump in unemployment, especially if we don't receive more stimulus from the government, which again is a double-edged sword. All the stimulus either has to be repaid or it inflates the currency, which is a tax on everybody, which is a regressive tax, by the way. So it's an election year, though. We don't expect that any politicians are going to do too much to anger the average citizen. Other economic data, we look at this data. It's called high frequency economic data because we get updates on this data daily, virtually. Because the mortgage purchase applications are up, consumer debit transactions are up, so people are swiping their cards more, hotel occupancy up. All these things are all trending in an upward direction. Just anecdotally, driving around town, it seems like there's more traffic now. I've talked with somebody that recently traveled to New York City. Seems like they're picking up, business is picking up there, so people are out and about, which, like many things, could be a double-edged sword. If people aren't taking proper precautions, that could just mean that COVID is going to be this thing that's going to spread and continue to be with us for a very long time. But people are getting sick of staying at home. So you see a lot of people out traveling about and doing things just because they're sick of being at home. One of the things that did happen this week, we got a U.S. GDP report. which was interesting. It was actually the worst GDP report in history, which was a historic 33% decline in GDP, which was worse than the Great Depression or the Great Recession 2008. It's somewhat to be expected if everybody was asked to stay at home and nobody's out buying things or traveling around. What do you expect, right? Of course, it's going to be terrible. But it was interesting to actually see the numbers and get the empirical evidence that it was indeed worse than anything we've ever gone through. Personal consumption was down significantly. That was a large portion of the GDP. Also, state and local spending was down. We expect to see some stimulus from the government to address that. We also had a Fed meeting this week. So the Fed came out as expected. They're holding rates steady at zero, essentially. They also said that we're committed to using the full range of tools to support the economy in this challenging environment. And then Jay Powell also said that the path of the economy will significantly depend on the course of the virus, which seemed a little bit like a hedging statement to some degree. So that was interesting to see that. But as long as Congress sort of gets their act together, we expect the Fed will follow in lockstep and we'll continue to see more stimulus and easing. Then last but not least, we also have this election coming up this year. It's hard to imagine we're already in August and we've got a November presidential election. There's the old adage, people vote with their pocketbook. And as you can see by this slide produced by JP Morgan, you see the percentage of Republicans and Democrats who rate the national economic conditions as good or excellent. You can see significant sort of drop off in that measure this week. This year. Late 2019, these numbers were near all-time highs for Republicans. But as you can see, sentiment has changed. So there's going to be turmoil, no doubt about it, with the election. We're hoping things remain somewhat calm. I think a lot of the major investment firms, brokerage firms, their folks all tend to think that we're going to have a Biden presidency. A lot of the big polls are saying the same thing. A lot of folks are thinking a Democratic sweep across the House and Senate as well. So we'll see what happens. I think it's going to get crazy, and I don't think anybody on the call would disagree with me on that notion. So again, things we're watching, social unrest continues. We see a lot of social unrest in the streets. It's somewhat race-based, but I think it's more deep-rooted than that. People are just upset. There's a huge disparity in wealth between the ultra-wealthy and everybody else, and I think that's sort of materializing as social unrest in various forms, racial inequality being one of them, gender inequality. As I mentioned, we're watching the election. We fully expect that a Democratic sweep would mean taxes would go up, which lead to some interesting planning discussions. Potentially, there's some things we can be doing now to take advantage of tax breaks now, assuming rates will increase in the future. Also, as I mentioned, inflation, money supply expansion. We're hoping we don't see a massive spike in inflation, but traditional economics would tend to lead us to think that that is sort of in the cards. So we're keeping an eye on that, the price of gold as well. Market breadth. So again, the big megatechs are running the market right now, driving the market. We're waiting to see if some of the other segments will catch up. COVID-19 developments, obviously any big news on that front could be just game changing. if through these vaccine trials that are happening right now, if we see some success there could be just a massive face-ripping rally in the stock market. That's a technical term, by the way. If a vaccine comes out and we find that, okay, everybody can kind of get back to normal in the next couple months. With all the money that's sitting on the sidelines right now, we didn't have any slides on those metrics, but there is indeed a lot of money sitting on the sidelines in cash right now. With some really positive news on the COVID-19 front, we could see the market just absolutely rally. Then also corporate earnings. So last week was a big week in terms of earnings. Again, the big megatech companies that performed pretty well across the board. So that's positive. We expect those stocks to continue to rally, and we're really looking at some of the other opportunities in the equity space as well. So that's all I had for today. Just a brief update on what's going on in the market. If you do have questions, feel free to reach out to us, email us, call us. If you're a client of the firm, feel free to call your relationship contact. If you're not a client of the firm, if you're a friend and you would like us to give you a second opinion on what you're doing, please feel free to reach out. Thanks a lot, folks. Have a great day.